Financial statements are the formal records of the financial activities and position of a business, person, or other entity. Think of them as a financial report card that tells the story of where the money came from, where it went, and what is left over. In financial economics and accounting, these statements provide the raw data used for valuation, risk assessment, and the CAPM-MIU models we discussed earlier. 1. The four core financial statements. There are four primary statements required under standard accounting frameworks, like GAAP or IFRS. Each has a specific measurement index, the logic used to value the numbers. I. The balance sheet, statement of financial position, what it is, a snapshot of a company's financial health at a specific point in time. The equation, text assets equals text liabilities plus text shareholders' equity, measurement index, historical cost or fair value. Assets are often recorded at what they cost to buy, but marked to market, fair value, for certain financial instruments. 2. The income statement, profit and loss, what it is, shows the company's revenues and expenses over a specific period, e.g., a quarter or a year. The equation, text net income equals text revenue, text expenses. Measurement index, accrual basis. Revenue is recorded when it is earned, and expenses when they are incurred, not necessarily when cash actually changes hands. 3. The cash flow statement. What it is, tracks the actual movement of cash in and out of the business. It bridges the gap between the income statement, accrual, and the bank account. The three categories. 1. Operating activities, core business. 2. Investing activities, buying, selling assets. 3. Financing activities, debt and dividends. Measurement index, cash basis. Only actual, greenbacks, moving in or out are recorded here. IV. The statement of retained earnings, equity, what it is, shows how profits are either kept in the company to grow or paid out to shareholders as dividends. Measurement index, book value. It tracks the cumulative historical changes in the owner's stake in the company. 4. Why financial statements are the lifeblood of finance. In the world of financial economics, these statements are important for three critical reasons. Evaluation, the intrinsic value, hunt. Finance is about figuring out what something is worth today based on the cash it will generate tomorrow. Without the cash flow statement, an analyst cannot perform a discounted cash flow (DCF) analysis. Without the income statement, you cannot calculate the earnings per share (EPS) or the P/E ratio. B. Transparency and agency theory. In finance, there is a principal-agent problem. The managers, agents, might not always act in the best interest of the owners, principals, shareholders. Financial statements act as a monitoring tool to ensure managers aren't wasting capital or hiding losses. C. Assessing risk in solvency. Using the balance sheet, creditors can calculate the debt-to-equity ratio. If a company has too much debt relative to its assets, its credit risk, which we discussed earlier, increases, leading to a higher beta in the CAPM model. 5. Key measurement indices, summary table, index. Statement. Purpose. Liquidity ratios. Balance sheet. Can the company pay its short-term bills? Profitability ratios. Income statement. How efficiently is the company turning $1 of sales into profit? Operating cash flow. Cash flow statement. Is the business real or just paper profits? Return on equity, ROE, equity statement. How much profit is generated for every dollar shareholders invested? Comparison of the three main statements. The balance sheet is the where we are, the income statement is the what we did, and the cash flow statement is the how we paid for it. Would you like me to show you how to calculate a few financial ratios, like the current ratio or debt to equity, using a hypothetical set of numbers?